If you've ever looked up stock market news, watched a finance channel, or even glanced at an investing app, you've probably seen the term S&P 500 plastered across the screen. Analysts obsess over it, financial headlines quote it daily, and fund managers constantly compare their results to it. But what exactly is the S&P 500? Why does it matter so much? And what does it mean for everyday investors? That's what we're going to break down in this video. Please do subscribe if you haven't already. It really helps this small channel grow. The S&P 500 stands for the Standard & Poor's 500 Index, named after the first two people that began tracking it. In simple terms, it's a list of the 500 largest publicly traded companies in the United States, measured by market capitalization. Market capitalization, or market cap, just means the total value of a company's shares. For example, if Apple's stock price is $200 and there are 16 billion shares in circulation, then Apple's market cap is $3.2 trillion. Bigger companies have a bigger influence on the S&P 500 index. So when people say the stock market was up today, they're usually talking about the S&P 500. It's considered the most important benchmark for the US stock market, and by extension, a reflection of the US economy itself. When you think about the kind of businesses inside the S&P 500, you'll probably recognize most of them from your everyday life. Tech giants like Apple, Microsoft, Nvidia, Google, and Meta all sit at the very top. Healthcare companies such as Johnson & Johnson, Pfizer, and United Health also feature on the index. Finance firms like JP Morgan, Goldman Sachs, Visa, and MasterCard are in the mix as well, alongside energy companies like ExxonMobil and Chevron. Consumer goods brands from Procter & Gamble to Coca-Cola to PepsiCo are represented, as are retail giants like Walmart, Amazon, and Home Depot. From the phone in your hand to the card you shop with to the toothpaste in your bathroom, the companies that make these products are all represented in the S&P 500. That's why following the index is a quick way to understand how corporate America is doing as a whole. But why do investors care about it so much? The short answer is that it has become the standard by which everything else is measured. Mutual fund managers, hedge funds, and ETFs are judged against its performance. If a professional money manager can't consistently outperform the S&P 500, many investors decide they would be better off just buying a fund that tracks it. Beyond performance comparisons, the index also represents investor sentiment. A rising S&P 500 suggests confidence in the US economy and corporate earnings, while a falling index usually points to fear or uncertainty. Retirement savings are also heavily linked to it. The majority of workplace pensions in the United States and some from foreign countries are invested in S&P 500 index funds. So millions of people already have exposure to it without even thinking about it. Even outside of America, the index has global influence. Because as the famous quote goes, when Wall Street sneezes, the rest of the world usually catches a cold. It's important to note that the S&P 500 isn't just a random list of the 500 biggest companies by size. A committee at S&P Dow Jones Indices actually decides which companies qualify. To be included, a company must meet certain standards. Its market capitalization must be above a threshold of around $22 billion. It must be consistently profitable for at least 4 consecutive quarters, its shares must be liquid enough to trade easily, and the business must be based in the US. That's why some big names including Tesla and Meta weren't always in the index. They had to prove stability before earning a spot. Another feature of the S&P 500 is the way it's weighted. Each company's impact on the index isn't equal. Apple and Microsoft move the index far more than smaller companies like Domino's Pizza. This is because the index is market cap weighted, meaning the bigger the company's value, the more influence it has. As of 2025, the top 10 companies make up over 30% of the entire index. So when tech giants like Apple, Microsoft, Nvidia, or Google have a big day, the index tends to swing with them. That concentration can be a strength, since you're exposed to the world's most powerful companies, but it also creates risk, because the index becomes much more vulnerable to downturns in a handful of tech stocks. One of the main reasons the S&P 500 is so admired is its track record. Since its official creation in 1957, it has delivered an average annual return of about 10%. That kind of consistency over nearly 7 decades is incredible. If you had invested $10,000 in the index back in 1980 and simply left it alone until 2025, you'd have nearly $900,000. That's all without ever having to pick a single individual stock. The index has weathered every kind of storm imaginable. Recessions, market crashes, political upheaval, wars, and even global pandemics. There have been painful downturns, such as the 38% plunge during the 2008 crisis, the 23% loss during the dot-com burst in 2000, and the 34% collapse in the early days of COVID in 2020. But time and again it has rebounded and gone on to set new highs. For investors, the beauty of the S&P 500 is that you don't need to buy all 500 stocks individually. Instead, you can simply buy a fund that mirrors the index. This can be done through index funds like the Vanguard 500 Index Fund or the Fidelity 500, or through ETFs such as SPY, VOO, or IVV. These funds track the index exactly. So when the S&P 500 goes up 1%, your investment goes up 1% as well. Because they are passively managed, the fees are often tiny, sometimes as low as 0.05%. This means almost all of your money is working for you rather than being eaten away by costs. Warren Buffett himself has repeatedly said that the smartest move for most people is to regularly buy an S&P 500 index fund and hold it for the long run. There are plenty of reasons why this strategy has become so popular. By buying into the S&P 500, you instantly gain diversification across hundreds of companies in nearly every sector of the economy. You get access to a proven track record of returns that have compounded wealth for generations. You also benefit from extremely low fees and automatic rebalancing, since the index regularly updates itself by dropping underperforming companies and adding stronger, rising businesses. That said, no investment is perfect. The S&P 500 carries risks that many people overlook. One major drawback is overexposure to big tech, like we've mentioned, where just a handful of companies account for a large portion of your investment. Another issue is that the index only includes US companies, so you miss out on potential growth from international markets and emerging economies. Volatility is also a reality. While the index has always recovered in the long run, short-term drops can be scary if you're new, and may tempt inexperienced investors to sell at the worst possible time. That's why many financial advisors recommend pairing an S&P 500 investment with other asset classes such as international stocks, bonds, or real estate to create a more balanced portfolio. There's another interesting point worth mentioning. The S&P 500 isn't just popular with investors, it's a goldmine for advertisers too. Financial institutions spend millions promoting products linked to the index, including ETFs, index funds, robo-advisors, and retirement accounts. As a result, terms like "what is the S&P 500" are some of the most searched investing questions online. The index has become the baseline of investing knowledge, the first concept people learn when they step into the world of finance. In the end, the S&P 500 is far more than just a number scrolling across the bottom of a news channel. It's the heartbeat of the US stock market, the foundation of hundreds of millions of retirement accounts, and one of the most reliable ways to build long-term wealth. It represents the collective strength of 500 of America's largest and most influential companies, and with the average annual returns of about 10% since 1957, it's proven itself over and over as one of the most powerful engines for compounding money. And for millions, if not billions of people around the world, it's the simplest and safest way to grow their wealth over time. Do you invest in the S&P 500, or do you think there are better investment opportunities for the average person? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching.